Many of our videos, you would have heard this word many times, and that word is diversify. Well, a lot of people have reached out to us and said that, hey, could you suggest how do we diversify? And that's what we're going to talk about. And I'll give you some rules of thumb that can also help you with that diversification. Hi, everyone. Welcome to our channel. In this video, I'm going to give you some rules of thumb on how you can have your diversification strategy or your asset allocation strategy. Hopefully, these rules of thumbs can help you not just diversify, but also check how and what your portfolio situation is. Before I do that, a quick introduction about myself. My name is Yogi, and my wife Seema and I, we both achieved financial independence and decided to retire early. And right now, we are leading this new retirement life after completing our one-year world trip. And interestingly, in the upcoming video, I'm also going to reveal where we decided to retire, how did we choose this location, how did we go through the process, etc. Till then, probably you have to just make do with this greenery behind me, and hopefully that itself gives you a hint. Anyways, back to the topic. I think by now, either through watching our videos or through your own information gathering, as well as your own financial knowledge, you would have understood the importance of diversification and why it is important to not put all your money in one basket and have that risk of losing everything or losing at least part of it if something happens to that particular investment asset. So that's what we're going to talk about in this video, that how, not the why part, because I assume that that's already clear, but how you go about diversifying. And to do that, first, let's try and understand the different types of investment options that are available to us. And let's put them into two buckets. One is what I would say the safe bets or low risk assets. Those are cash in the bank, fixed deposits, bonds, gold, or precious investments in precious metals. There could be a few more, but generally these are the ones that we invest in, and these are typically the low risk assets or generally the safe bets. As you might have probably also know by now that all kinds of investments have certain level of risk, but these relatively have less risk. And then there is this other bucket, which is, I would say, risky assets or not so safe bets. And those are investing in the stock market, investing in a startup, maybe crypto, real estate. So those are the investments where you will probably have high rewards, but you will also have a higher risk than those safe bets. Success to financial independence is to find that good balance between those safe bets and those not so safe bets. And that's where I will give you some rules of thumb that have worked for us and still working and hopefully continue to do so. But not just us, but a lot more people in the world, it has worked. So see if you can check your portfolio against those rules of thumbs, or maybe calibrate your portfolio based on that. As I said, these are rules of thumb. So you will have to be the judge that do you need to calibrate based on your risk tolerance, your risk profile, your financial acumen, your knowledge, that where you want to calibrate and how you want to calibrate. So let's take the first one, and that is how much money do you put in those safe bets or those low risk assets. My rule of thumb is that you put your age as a percentage of your total net worth into those safe bets or those low risk assets. So if you're 20, that means you put 20% of your total net worth or your total investments into those assets. If you're 60, that means you put 60% in that. So what is that? So that means that, as I defined earlier, so you're putting, based on your age, your percentage of your investment in cash in fixed deposits, in bonds, and in precious metals like gold. Now, it doesn't mean that you have to buy physical gold. You could have exchange traded funds of physical gold. So you're not physically owning gold, but you are buying those ETFs linked to gold. And bonds, for those of you who are probably new to the bond market, bonds are the money that is basically loaned by a company, a large corporate, or even government through the money that they borrow from the public. They give you a certain interest, and there is a period on which there is a maturity. And those bonds, because they are at a much more macro level, so you can buy them like shares from the public market. But generally, these are the safer bets. So in summary, the first rule of thumb is that you're putting your age as a percentage into those investments. So if you investing 100 rupees or $100, so that means if you're 25 years old, you're putting 25 rupees of that into these assets. And as I said earlier, this is rule of thumb based on your risk appetite, based on your risk tolerance, and based on your financial acumen and knowledge. You may decide to increase or decrease this. So if, for example, you're just in your mid-20s, you may decide that, hey, my risk tolerance is a lot more than probably an average person, and I believe and I'm confident that even if I lose part of my money, I have the capability to recover and make money out of that. So you probably do not do 25% into this. You may even do 0 or 5 or 10%. So use this as your own judgment, but I would still say that go by that rule of thumb with certain plus minus variance to that rule of thumb. Now, within this first rule of thumb, the second rule of thumb is that how much money out of that safe bets or the low risk assets should you have in form of liquidity? And that's your emergency fund. This is again something that I've spoken in other videos of mine. And the simple formula that I use and the simple rule of thumb that I would recommend for you to do is 24 minus the years to your target retirement age. And that is the number of months that you should have your emergency fund, with a minimum being 6 months at least. So for example, if you are 30-year-old and you would like to retire at 50, that means you've still got 20 months to go. So 24 minus 20, that means you should have from that formula 4 months as emergency fund. But as I said, the minimum should be 6 months. So you should have 6 months in that case. On the other hand, if you're 30-year-old and you want to retire at 40, so that means you only have 10 years to go towards your target retirement age. So that means 24 minus 10. So that means 14 months is what you should have as emergency fund. And what is that emergency fund? Emergency fund is cash or any of those short-term fixed deposits that is easily accessible in case of emergency. So that will also help you decide from this rule of thumb that not just putting the percentage based on your age into those safe bets, but out of that percentage, how much should be in cash or in short-term fixed deposits, which is easily accessible and that doesn't have a penalty on it, either by the market variation or in form of losing the interest or certain financial penalty to withdraw that. So that becomes a subset of your safe bet as emergency fund. So these two rules of thumbs were on the safe bet side or the low risk asset side, and that helps you how much should you have in that low risk asset side. When you're putting the rest in the other bucket, the first rule of thumb in sequence, the third rule of thumb over there would be that minimum out of that 50% should be in either of exchange traded funds, mutual funds, index funds. So let's say you're 20 years old, and that means you put 20% by that rule of thumb into those safe bets, And out of that 20%, you have 6 months of an emergency fund in form of cash or in short-term fixed deposits. The rest 80% is in those riskier assets or the not so safe bets. And over there, out of that 80%, the 50% of that should be in, at least a 50% of that should be in ETFs, in mutual funds, and in exchange traded and index funds. Why? Because this gives you an exposure to the entire market. And you're not just putting your eggs in one basket or one share. And you're also getting the right exposure to the equity in the stock markets. And you're still having, I would say around 50% to invest in crypto, in real estate, in startups, etc. Ideally, there are certain philosophies, like there is this bogglehead strategy or vanguard strategy, that they say that you should invest all of your risky assets into the index traded funds and ignore the real estate or crypto or any other. But as I keep saying, it's rule of thumb. So it depends that if you would like to have more or less, but at least 50% of that should be in that coverage. The fourth is linked to that is that, yes, you may own individual stocks, but in that risky part, you should not have more than 10% of your total investment in one particular stock. So that means, again, in that same example, if you're 20 years old, you've invested 80% in this, and out of that 80%, you've invested 50%, that is 40%, into the ETFs, mutual funds, etc. And the rest remaining 40%, you should not have more than probably 8% in one particular stock. Now, why? Because you're exposing yourself too much to one particular company. This happens especially when you're getting RSUs or ESOPs or stock options from the company that you're working for, because then, as part of your annual bonus, as part of the incentive that many times you have on a monthly basis to buy equity from the company where you're working at a discounted rate, that number goes dramatically high. And what happens is that you end up with what I call the double whammy situation. That is, your salary is coming from the same company or invested heavily into that same company. And if something happens to that company, you not only make your job at risk, but you also put a major investment at risk. So ideally, if you're getting RSUs and you're getting that, keep rebalancing. So you keep selling part of those RSUs as and when they are vesting and unlocked, and keep rebalancing into those index traded funds or mutual funds. So you're still diversified, you're still into that not so risky bucket, but at least it is making sure that you're not putting your investments vulnerable to just the future of one company. Now, this rule, again, it will depend on how good you are with your financial acumen, etc. You may decide that you know so much of the financials of one particular company, that what is their future cash flow, how does it look like, what is their investor report saying, where are they investing in terms of AI or any other technology or any other things that they are doing, that you think that you can bet your money or you can take a bigger risk. Do that, but again, just be careful that if you put more than 10% of your total assets there, you're risking your money there. So simply put, and in summary, the 4 rules of thumb that you should follow, the first one being that put your age as the percentage into the safe bet category or the low risk assets category. The second being is that have an emergency fund out of that safe bet category, that is of minimum of 6 months and up to 24 months, that is either in form of cash or in short-term fixed deposits. That becomes your second rule of thumb. The third rule of thumb is that in the not so safe bet or the riskier assets category, make sure that 50% of that money is invested in exchange traded funds, index funds, or mutual funds. And preferably, when you're doing mutual funds, you can have low cap, mid cap, different kinds of funds based on industries so that there is a diversification there. And the last one is what not to do, because these three are what to do. And that what not to do, the last one, rule of thumb, is that not more than 10% of your total not so safe bet or the riskier assets category should be invested in one particular individual stock, especially in the company that you're working for. And if that is the case, keep rebalancing. And how do you calibrate these 4 rules of thumb? Is that use your judgment based on your risk tolerance, your risk appetite, your financial acumen, and that is very important. And use that to calibrate and see that if you are going to take a lot more risk in those early years, or even at the retirement years, you may say, hey, if I'm 60 years old, I do not need to put 60% of my assets into that safe bet category. So be a judge of that. And what you should not be doing when you're following these rules of thumbs is, one is, do not go for that FOMO effect. That if you see that your neighbor, your friend, your colleague is investing in the next sexy crypto or a new startup, etc., you're just doing it just because everybody seems to be doing it. Do your research, do your analysis, build your financial acumen before you do any such thing by just following what the market or the media is saying. If you do follow this, I think you will have a fairly good distributed asset allocation strategy and you will be fairly well diversified. This has worked for us, and this is one of the key successes or the reasons that we were able to have our money grow faster while still being secure. Again, as they say, past performance is no guarantee to future success, so we don't know how it will look like in future. Fingers crossed that this keeps working on. And over a period of time, in coming weeks and months, I'll also keep updating and saying that, hey, this is still working and it is still helping, or you need to calibrate one of these rules. I hope that doesn't come that I need to tell you that you need to calibrate these rules of thumbs. So I hope you found this video useful. You got some new insights about the asset allocation strategy. If you have any suggestions, comments, thoughts on the strategy or a 5th rule of thumb, would love to hear from you. Please do comment below the video, and also like and subscribe the video and share it with your friends and family. Till the next video, till the next location, and till the next topic. Goodbye from me. Bye-bye.